Good day to you all, ladies and gentlemen. Welcome to our YouTube channel, Matrix Investing, a channel that is dedicated towards educating you on the aspects of investing in capital markets. Now, in this video, we're going to learn about what investing is, what capital markets are, and the advantages you as an investor would get if you were to invest in such markets. If this video has been by any means helpful to you, please help us out by smashing the like button below, subscribing to our channel, and hitting the notification bell so that YouTube can notify you each time we get to upload a video. Now, with that said, ladies and gents, let's get down to business. Alright. So what is investing? I'm pretty sure this word ain't new to you all. You must have heard of this word somewhere. You must have even talked about this word. We experience this word investing in our day-to-day lives in one way or another. So what is investing? Now, I'm going to define this in relation to business-wise. So then technically investing is anything that promises a safety of capital invested and adequate returns, but after a thorough analysis. So then let me review this definition one more time. This is anything that provides a safety of capital invested and an adequate return, but after thorough analysis. So then from this main definition, from this key definition right here, once we get to break down this definition, we're going to get three main aspects. So then that's safety of capital invested, adequate returns, and thorough analysis. So then let's dive into these three main aspects. So then starting off with safety of capital invested. So technically, anybody who has the intentions to invest should consider picking investments that will ensure no loss on capital invested, but the appreciation of capital over a long period of time. So then what this technically means is that for any scheme, project, business that you're intending to invest in, for it to be considered a worthy investment, you have to guarantee yourself, or there has to be an insurance that once you invest in that business, the business will generate more, the business will generate a surplus capital. So then that means that whatever capital you invest there, you should expect it to increase in value over time. So then the increase in the value of your capital invested is what we call, or is what we term, capital appreciation. Well, that's in financial terms. So then giving you an example, when an investor invests 100,000 TZ shillings into a scheme and the capital grows to 150,000 shillings. So then what we've seen here is that the value of this capital investment, the value of this capital has increased from 100,000 to 150,000 over a period of time. So then for this sort of scheme, it would be considered a worthy investment. But then, however, if the capital were to decline from, let's say, 100,000 to 80,000 shillings over time, then this wouldn't be considered an investment anyways. This would be crap. It would be like a place where you went to blow up your money, you know, because like investments are originally meant to increase your value, to increase the value of capital you've invested originally. So then moving on to the next aspect, adequate returns. Now the operation that you intend to invest upon should provide returns in form of payments. The payments motivate the investor to invest more and is also a reward that an investor deserves for risking his or her money into the operation. So then leaving aside the aspect of capital appreciation, we all know that your business is gonna appreciate, your capital is going to appreciate in value over time. So then leaving that aside, you as an investor should get paid you should get paid some money for like investing, you know. This money could be in form of dividend, interest. If it was real estate, it's rent, you know. So then technically if it was business, it would be profits. So then technically this amount of money that you're paid as an investor, this also helps, this also contributes to as to whether a scheme, project, business, or whatsoever, for it to be called a worthy investment, it should be able to pay you. So then leaving aside the aspect of capital growth, this business should also be able to pay you, like give you some cash, like, you know, walking money. So then giving you an example, despite the appreciation of capital, relating to the previous example, despite the capital appreciation from 100,000 to 150,000 shillings, the investor managed to get a 20,000 shilling payment on the capital invested. Now, however, these adequate returns are more based on what you've invested. So then the more you've invested into a scheme, the more your chances of getting paid, and the less you've invested in a scheme, the less likely you're to get paid. Like, you'll get paid little amounts of money. So then it's all up to what you've invested originally. If you've invested big, you get paid big. If you've invested little, you get paid little. But then yet the most important breakdown in the word investing is thorough analysis. So then reading on, this is a very important aspect before concluding to invest. An investor should perform research and analysis upon the scheme expected to be invested, and this helps reduce the risk as an investor gets to identify schemes that perform well and those that don't, and invest in those that do well. So then technically thorough analysis is basically that part of investing that is there to like tell you these investments are good, invest in these investments, leave aside these ones suck, they're gonna blow up your money, and don't touch these ones are pretty much, they're just there for show. Okay, so then technically thorough analysis, what thorough analysis means is that you as an investor, you get to sit down, chill, get to understand this scheme, get to read through its business, get to understand how this business works. You get to look at its financial statements, you get to look at its financial situation, and from all that data you've collected, all that data you've summarized, so then you're basically able to know as to whether this investment is worthy or this investment is just, one to be left on the sidelines. So then technically thorough analysis is basically a lifesaver, because like instead of diving heads in and it's basic, instead of like going heads in into an investment you don't know about, chances are you might die, chances are you might live. Thorough analysis is there to reduce those chances and tell you, leave aside these bad ones, go for these good ones. Out of these good ones, the very best are this, and this. Invest in this, and this, and your capital is expected to grow by this and this and this rate. Of course, this is not an assurance. As I say, this is not an assurance, because thorough analysis is based on analysis on past performances of the business. So then from the past performances, it is up to you as an investor to conclude as to whether this historical data can apply towards the future or not. So then as we make more videos, you'll get to understand how analysis works. So then chillax. So then what are capital markets? Now, capital markets are basically markets where organizations go seek funding and investors go seek well-performing investments to invest in and attain profits from. It's simple. Organizations head on to these markets to seek funding, fundraising, and investors head in looking for it. Out of all these organizations that have come to seek funding, basically investors are like, which one of these organizations are worthy of investing in? Like, which one of these organizations will I be able to put my money and be sure that I will get capital appreciation, I'll get paid heck ton of cash over time. So then capital markets, just like any other markets, have got two main sides. So then the first side of the capital markets are the organizations. Now basically the organizations are groups that participate in the capital markets with the aim of raising capital from investors to further expand their operations. So then let's get on to like normal terminologies right here. So then let's say a business or some sort of organization such as the government is continuing its day-to-day operations just like normal. It has its own capital. It's doing what it does best. Just right there. But then these organizations have their own goals. They want to grow. They want to reach a certain level of productivity. They want to reach a certain level of greatness. Now then, in order for them to do that, they need to get more finances. They need to get more capital for them to reach these higher levels of growth, these higher levels of production, these higher level of greatness. So then for these businesses, for these organizations to attain such capital, to attain this extra capital that can help them move miles ahead, for these businesses to do that, one of the places they would obviously go to, and no, not the bank, one of the places they would obviously go to are the capital markets. So then they would just go to the capital markets. If they meet up with all the regulations, if they meet up with all the guidelines, they get to pitch in So then from there they get to like raise capital to two main ways, which is one through shares and the other way is through bonds. So then we'll get onto these later on. So then organizations are typically in the capital markets with the aim of attaining finances from investors and to use this finance to further expand their business, to further grow their business so that their businesses can reach goals, visions, missions, their dream, So then that's why they're here in the first place. So then examples of organizations are NMB Bank. I mean, the NMB Bank is listed in the Dar es Salaam Stock Exchange, which is a capital market. There is Vodacom, which is also listed in the Dar es Salaam Stock Exchange. There's the Bank of Tanzania, which has bonds, like it has treasury bonds. So then bonds are also means to raise finances. So then, yeah. Now, moving on to the other side, of the coin, the investors. Now, these are technically individual people or organizations that participate in the capital markets by seeking different well-performing organizations with the aim of investing in them and attaining profit. So then, investors could either be individual people such as you and I, or well-established organizations such as businesses seeking to invest in other organizations that show the potential of performing well on into the future. So then technically your role as an investor in the capital markets is for you to sit down. All those organizations are going to come to you like, give me your money, give me your money, give me your money. I promise I'll make you like great returns on your capital invested through like capital appreciation or through dividend payments. So then we all know that that's what they're obviously going to tell you. So then as an investor, you have to sit down, calm down, analyze each and every single organization and try figuring out which organization is the darling and which organization is the, is going to blow up your money eventually. So then like your role as an investor is to invest into these organizations. But then of course as an investor you do not want to lose you don't want your capital to lose value. You do not want to go dry, like just cash in and not get anything, like not get any sort of payment. And of course, by doing so, you have to sit down, analyze through all these organizations, check them all out, and from there, squeeze out the ones that are the best of the best and invest in the best of the best. So then, yeah, an example of an organization that is technically an investor is Nickel National. It's like a National Investment Company Limited. It's also listed in the DSE. I would say it's a holding company because it has interest, it has stakeholding, it has shareholding in other companies such as Vodacom, NMB, Trigger Cement, and etc. And another example is this person over here who's looking at the laptop, representing all the people who are going to be investors or all the people who already are investors. So then, yeah. Now, let's get on to the next aspect. Advantages of investing in capital markets. So then let's get down to it. The first advantage that is there is source of income. So then investors in capital markets are paid based on the amount of capital they've invested in these financial instruments. So then investors owning shares are paid dividends based on the amount of shares they have on the company, while investors owning bonds are paid interest based on the amount of money lent onto the institution. Now, given the example of ownership of CRDB shares that pay a dividend of 17 shillings per share. So then let's do the math right there. Basically, the more the capital you invest in the stock market, the more the capital you invest in shares, the more the shares you get to own. So then using this example right here, ownership of 10,000 shares that pay a dividend of 17 shillings per share. Now, a dividend is basically the money you get paid based off on the number of shares you own in a business. So then if this investor technically this investor would be able to walk out with money in the pocket or money in the bank that is worth like around 170,000 shillings. That is before tax, of course. So then like right there, that is just an example of what, like, that is that is an example that is stressing out on how capital markets can provide you the source of income. So then, however, this is based on the amount of capital you've invested. So then, let's say if this investor were to own 5,000 shares, then we'd see that the dividend payments themselves would be low, as there would be 85,000 shillings. So then if this investor were to own say 25,000 shares into CRDB, this investor would get paid 425,000 shillings. So then, unlike a job where your salary is fixed and you have to bargain for your salary, in the stock market, when you invest in capital markets, using this example of shares, your payments are not fixed. They're based on the decisions you make and how much money you choose to invest in this particular scheme. However, moving to bonds, investing in treasury bonds that pay a 15.49% based on the as an annual interest based on the capital you've invested. So I'm going to just change this into decimal, and there we have it. So then let's assume that you were to invest, let's say, 1,000,000 shillings. So then if you invested 1,000,000 shillings, you'd walk out with 154,900 shillings worth of annual interest from owning a treasury bond. However, just like I told you, this is all based on the amount of capital you choose to invest. If you're to invest 500,000, you'd walk out with 77,450. If you're to, let's say, invest let's say 5 million, you'll be able to walk out with an annual interest of 774,500 shillings. So then all this, these sources of income, yes, they're there, but then also they're all dependent on how much money you choose to allocate into these particular schemes. So then the second advantage is source of capital appreciation. So then technically capital appreciation is the increase in value of your capital. Now this advantage is more specific and more likely happens in the stock market when you invest in shares. Now this appreciation is realized when an investor buys shares at a low price and later on sells them at a high price. So then we all know that organizations that seek funding through issuing of shares, technically these shares are listed in the stock exchange at a certain market value. Now for several reasons, the market value could tend to increase or decrease depending on several reasons, such as the demand of the particular shares, let's say the performance of the business, the leadership, its decisions, its image towards the public, and all that stuff matters. Okay, so then using the example given below, let's say you were to own 1,000 DCB shares. Now DCB is basically our commercial bank. Now if you were to own 1,000 of its shares at the market price of 4,000, so then 1,000 of its shares at the market price of 4,000, you'd originally have invested 400,000 shillings as capital. Now let's say for all these various reasons, the business's market price doubles. So then from 400, the market price doubles to 800. So then right there you'd be able to have, the capital you've invested will now be worth 800,000. So then if you're to compare this 800,000 with the original amount of money you've invested, which was 400,000, you've been able to walk out with a profit of 400,000, and that alone on capital invested. So then this is another advantage of investing in such capital markets. Moving on to the third advantage, which is ownership rights. Now, as far as investing in shares is concerned, an investor has ownership into a business as long as he or she has shares of that company. And the more the shares of that company owned, the more the ownership an investor gets to have. Now, basically, ownership is all based on the amount of ownership is technically based on the other side of the capital, this asset class of the capital market, which is shares. So then technically when a business enters the capital markets, it offers to issue shares. Now these shares are transacted between a business and an investor. An investor pitches in capital in exchange for these shares. Now these shares represent the amount of ownership and the amount of capital that an investor has invested. Now in normal terms, we all know that a person who contributes capital into a business, into an organization, is known to be an owner. So then you basically have ownership rights. You get to own various big companies that make up our Tanzanian economy, such as NMB, Vodacom, and all these other mega companies through ownership of these unitary shares. And that, my friend, there is an advantage. So then you get to make decisions that impact how these businesses perform and all that. Now, however, all of this, like I told you, is all based on the amount of capital you've invested. So then the more the capital you've invested, the more the shares, which means the more ownership and control you have over the business, and which means the more your decisions are going to be influential, and then the less the capital you've invested, we'll know what that means: less ownership, less influence. So then that's technically it. The fourth advantage is easy diversification. Now, investing in capital markets can give you a variety of options, choosing to invest either in shares or bonds. So then when you invest in capital markets, you have a choice. You could, basing on the complexity of the Tanzanian capital market, you could either invest in shares, you could either invest in bonds, and leaving these two asset classes aside, there are a bunch of companies, there are a bunch of institutions seeking to raise funds from these asset classes. So then you have a huge list of organizations, a huge list of institutions from the stocks, and there's a good number of institutions from the bond side. So then from there, all you have to do is like filter out which one does good, which one doesn't do good, invest in these organizations, and then boom, you can have ownership into several businesses in the stock market from several different sectors, and you could lend out your money. You could be the bank to banks. You could be the bank to conglomerates. You could be the bank to several other businesses through the bonds, investing in bonds. So then technically, imagine if you're to say, let's say you had a dream of starting an insurance company or like owning an insurance company, and let's say you never had the chance to due to capital, or let's say the risks involved, all the expenses, all the booms, the busts, the explosions, all that stuff a business tends to have when you're trying to start. So then technically, the road, like you could like the short way out to it is basically if the stock exchange of your particular country, let's say Tanzania, for example, if the Tanzanian stock market had a good insurance company listed there, you could finally have the chance to own it. I mean, it's right there. You could own it. You could invest your capital into it, acquire shares. So then, boom, there you have it. Yeah, win-win. So then, that is the advantage. Easy diversification. You get to own multiple businesses. You get to invest in multiple businesses from different sectors of the economy, and therefore have great performances from different aspects that contribute to the country's economy. Now, moving on to the final advantage, which is very low cost. So then getting into investing in capital markets, the cost of entry and the cost of staying there are kind of very little as compared to investing in other assets such as real estate, starting up your own business, or even like having a job, let's say. So then I'm going to give you examples. So then let's talk about brokerage costs. Now then, brokers are technically people who invest on your behalf, and yes, it's a must for these people to invest on your behalf. Now, brokerage costs could go up to 2.06% of capital invested when you either buy or sell shares, while on bonds, brokerage costs would range from 0.03 to 2.366, depending on the type of bonds and the amount of capital to be invested. So then, giving you an example, let's say let's first of all convert these percentages into decimals, because then it's much more easier to operate the calculator with decimals. Okay, so then 2.06% of capital invested. Say you were to invest 1 million, like you're to buy 1,000,000 shillings worth of shares. The cost to entry, like the cost of acquiring these shares, would only be 20,600. Now just look. 20,600 in relation to 1,000,000. Okay, yes, every penny counts, but come on, guys, we can't be that much frugal. Like, you're gonna have to cash out a little bit to get more cash in the long run. So then, imagine all you have to do is pay up 20,600. Like you could even put that on top, like it would be 10,000, 20,600, and this 20,600 is dedicated towards paying these investors costs so that the million can get in and get me shares. Like you see, the costs are so little. Let's say you're to invest 500,000, 500,000, you just have to pay 10,300. Like the costs are so little. Like these are like this is a very good thing. Like getting into investing in shares requires you to pay such little upfront. Now let's look at bonds. 0.03 divided by 100. Imagine if you're to invest, let's say 10 million. 10 million. You'd have to pay 3,000 based on the 10 million you've invested. Like for real, guys. Like just look at how these costs. Like just look at how insignificant these costs are and how much you would be able to get. Like how much you'd be able to profit in the long run. Like you'd be able to profit so much from such little. You'd have to, like, from these little costs you have to incur right from the start. Now let's say 2.366 percent. 2.366, let's divide that by 100. Let's multiply that by a million. Okay, a million, 23,660. It's no, it's like there's like a very minimal difference between the 2.366 costs in bonds and the 2.06% in stocks. So then basically these are very low costs. These costs are kind of insignificant when you're trying to enter in the stocks or in the bonds of the capital market. Now the 0.03% to 2.366% depends on the type of bond and capital to be invested, yes. And hopefully as time goes on with our Tanzanian capital market and as more investors tend to become aware, I'm pretty sure the costs might even drop down a little. Like I'm not surprised if they would. Like these costs, I'm pretty sure they would like spiral down and you'd have to pay like even less towards attaining ownership into such investments. Now moving on to taxes. So then for dividend income, let's say you invested in shares, you get paid dividends. So then the tax you'd get cut off from dividends is like as low as 5% based on the tax policies that regulate the country. So then 5%. Now let's look at the original examples. Owning 10,000 NMB owning 10,000 CRDB shares that pay you 17 shillings per share. So then that right there was 170,000, and boom, you'd only get cut 8,500 from your 170,000. Just look at how insignificant the tax expense is. The tax expense is very minimal, like compared to if you're to start a business, or if you're to be employed, or if you had real estate. Like look at this is 5%, 8,500 on 170,000. Like seriously, guys. I mean, this is lit. This is lit. Let's say you're to be paid a mil worth of dividends. You'd only get cut off 50,000. Like it's just 50,000. Like that's it's very insignificant, guys. So then moving on to the side of bonds, bonds, like they pay you interest. So then you can get taxed on interest, but then the interest, like the tax deductions, the tax rates run from 0 to 10%, like 10% of a million. Okay, I know that's like a bit higher than if you got dividend income, but 10% also it ain't as big of a deal. Come on, guys. You get to keep 90% of the stake. I mean, give the government a break, guys. So then, yeah, there's 10%. 10% of 2 million. Okay, so then that's 10%. Now, like I told you, it ranges from 0 to 10%. Now, it ranges. Now, there are bonds you could invest in and walk out with 100% of the interest income, like 100% cash in the bank, 100% walking money. I didn't get my money cut by the government, yeah? So then these 0% tax rates depend on the type of bonds you invest in. If you invest in treasury bonds, now the type of bonds and the duration of the bonds. If you invest in long-term treasury bonds, you're you are going to get tax-free interest income based on the capital you've invested. However, if you're to invest in corporate bonds, which is bonds that businesses issue, you're probably going to get cut down like 10%. So then treasury bonds are like government bonds. Now if you invest in long-term government bonds, boom, you're tax-free. And however, if you also to invest in short-term bonds, there's no running away from tax there. You're going to get cut. You're going to get cut. And the government bonds there that usually get cut interest are like the treasury bills, which last from 35 days to 1 year, and the 2-year treasury bond. So then you get cut your 10% interest income on those particular bonds. So then with that said, we have finished this presentation. We've finished this video. So thank you very much, folks, for tuning in, for watching this video. I hope this video was very, very useful to you all. If you found this video useful, please smash the like button, hit the subscribe button, click the notification bell so that you do not miss out on our content. But also, if you're in social media, like if you're on social media, big shout out to our accounts, Matrix Investing. We're on Instagram, we're on Facebook, we're on Twitter, we're on Matrix Investing. We create content on a day-to-day basis that is related to investing in capital markets, particularly the Tanzanian ones, investing in shares, bonds, and if you have any question whatsoever on matters related to investing in capital markets in Tanzania, you will check us out there. We'll be free to reply with just a DM away. So then thank you folks, thank you for tuning in. Have a nice day. Peace.